Welcome to our latest podcast. I'm Derek Barrow from Santander Asset Management. I'm joined today by our Global Head of Macro, Tactical Asset Allocation and Alpha, Haydn Davies. Good morning, Haydn.
Good morning.
Okay, so let's kick off straight away. With UK inflation falling more than expected in June, UK inflation finally looks as if it has peaked. Is the Bank of England's battle against inflation won? And if not, what is the outlook for inflation and interest rates?
Gosh, is the battle against inflation won? I think I'd probably say that maybe central banks, policymakers are winning, but yes, the battle is not over yet, and certainly has some way to go, particularly in the UK. But certainly over the course of this year, we should see inflation moderate quite noticeably in the UK. But after that, it's going to be a little bit sticky. So some good news, some bad news. I think it's worth putting in context what we've seen over the last couple of years. So inflation's been very high. I guess everyone listening knows that. Over the last couple of years, prices have risen as much as they have or they had over the previous 10 years. So inflation has been very much out of control and very different to what we've been expecting or got used to in sort of the previous couple of decades. As you pointed out, it now looks as if inflation is peaking. So we've got UK inflation at just below 8%, and it peaked at 11% back in October. It's been very stubborn above 10% for quite some time throughout the winter and throughout the spring. But now it is heading down. And there are good reasons to think that that will continue. So first of all, of course, natural gas prices attracted a lot of publicity in the last couple of years. We all know that the energy price cap has recently been lowered, and that will affect the inflation reading that we get in the middle of August for July's number. So we know that energy prices will continue to exert a disinflationary impact. So gas prices are falling, oil prices are falling. That will help to bring down the headline rate of inflation. Natural gas prices are back to where they were the summer before the Ukrainian war started, for example. So that's all very good news. And similarly, the price of filling up a car, the price of unleaded petrol has fallen by a third over the last year. So again, that's going to be disinflationary. So energy prices, which have been pushing inflation higher, are now acting in reverse. They're helping to bring down inflation. Food price inflation, that's also peaked, and we should start to see that moderate quite noticeably over the remainder of this year. And similarly, we can measure price pressures earlier in the supply chain. So we can measure the prices, when they're rising, falling, as they leave the factory before they hit the shops, as it were. And that so-called producer price inflation, factory gate inflation, prices are actually falling relative to where they were a year ago. So that would suggest that certainly the price of a lot of goods is not going to rise over the remainder of this year, and indeed some goods prices could fall. We shouldn't see car prices jump the way they have over the last couple of years, for example. So that's all the good news. So prices will temper, inflation will moderate over the course of this year. Headline inflation, currently 8%, should fall to below 5% by the end of the year. Of course, that is still a lot higher than the Bank of England's 2% target, and it's a lot higher than we've got used to over the 2010s, for example. And unfortunately, it's the case that there is sort of an element of inflation that is still very sticky, and neither the Bank of England or economists really expect that to temper anytime soon. And that is essentially inflation for services. So services range from obviously dog walking to travel insurance to airlines booking hotels to car insurance. So transport covers a whole range of services, and that's actually where people spend most of their money. It's not actually on goods that they buy in the shops. And service sector inflation is very stubborn, so that's running at about 7%. And the biggest contributors to that, the biggest reason why service sector inflation is so stubborn, essentially two things: it's rents and it's wages. And wage inflation is above 7%, and rents have been rising very strongly as well for a variety of reasons. And certainly, if you look at the survey of the Royal Institute of Chartered Surveyors, estate agents, they certainly don't expect rent inflation to cool anytime soon. And certainly with the labour market still as tight as it is and a lot of vacancies going unfilled, it's difficult to see wage inflation moderating that much, although we would expect wage settlements to start to reflect the better inflation regime in terms of headline inflation over the coming months, but it's going to be a sort of a slow slog. And that's really why the Bank of England, in its latest inflation report, monetary policy report, really highlighted that whilst it thinks inflation will fall notably over the remainder of this year, it's not going to be until 2025 that it thinks inflation will reach its 2% target. So there's the good news there that inflation is falling and indeed could fall quite noticeably over the remainder of this year. But the bad news is it's still these underlying ingrained pressures that mean that the Bank of England can't let up in interest rate policy. So UK interest rates now 5.25%. The market is expecting the bank to raise interest rates twice more to 5.75%. To some extent, that is better than had been expected. So at the beginning of July, the markets were expecting UK interest rates to reach not 5.75%, but actually 6.25%, and that followed the sort of the disappointing inflation news earlier in the summer. Looking forward, as I said, UK inflation ought to fall noticeably and stop disappointing. And that means that the Bank of England can call it a day a little bit earlier than it appeared earlier in the summer. So certainly some good news on inflation, but as for whether the battle is won yet, sadly not. There's still a way to go.
Excellent. Thanks for the answer. So given that stock markets have actually made a strong start to 2023, especially in the US, what's the outlook for the second half of the year?
Yes, certainly a lot of stock markets have had a very good 2023 so far. So Japan has attracted a lot of headlines. The Japanese stock market's up about 20%. The US stock market, that's up 20% too. The UK's been lagging behind a little bit, so only really sort of low single-digit figures. European stock markets up 15% as well. So 2023 so far, a pretty good year for stock markets. Perhaps before talking about the outlook, let's again try to put that in context. So last year, most people listening to this podcast will remember that it was an awful year for stock markets. They fell in the region of 10 to 20%. And if we actually look at stock markets now compared to where they were at the start of not this year, but the start of last year, actually by and large, they're flat. So stock markets this year simply have by and large erased the losses that they incurred last year. And of course, that's the nature of equity markets. They're very volatile. The exception there is Japan. So Japan is up about 15% compared to where it was at the start of last year. The US stock market, even though it's done really well this year, is actually still lower than it was at the start of last year. The UK up a little bit. So 2023 has been a good year so far, but in the context of sort of the last 2 years, it still hasn't been a great period for equity market investors. And it's also worth bearing in mind that the impact of exchange rates. So if you're a sterling investor, you're a UK-based investor, and you invest in the Japanese equity market, you're not just getting the performance of the equity market, you're getting the performance of the pound versus the Japanese yen as well. So because the Japanese yen has fallen against the pound, actually, whilst the Japanese stock market's gone up 20%, as a UK-based investor, because you have lost on the depreciation of the yen, you've made only 5%. So because the pound has appreciated, it actually sort of makes the stock market performance across countries a little bit more of a level playing field. So once you factor in sterling's appreciation this year, because the Bank of England has been raising interest rates, actually from a sterling-based investor, equity markets are up about 5 to 10%. In terms of the outlook for the remainder of this year and looking into next year, well, I suppose it's important to bear in mind that normally we would expect, on average, stock markets to rise between 5 and 10% a year, maybe 7% a year on average. So far this year, the stock markets have been doing much better than we'd normally expect in an average year. And that would suggest that there's reason for some caution in the second half of this year. Equity markets have rebounded quite strongly this year because, one, it appears that central banks are close to calling it a day in terms of raising interest rates, and two, because the growth picture has been better than people expected. But looking further ahead, growth doesn't appear to be as if it's going to be that strong certainly over the next 12 months or so. So, for example, this year, the UK is barely going to grow. Next year, it's going to grow only about 0.5%. That's not a great backdrop for UK equities. Europe is expected to grow 1% next year, grew only about, or expected only to grow about 0.5% this year. So at least it's not a recession, but it's still pretty weak growth. And that's not the best, obviously, backdrop for equity markets. The best backdrop for equity markets is obviously very strong growth. The US is expected to grow about 0.5% this year. It's now expected to avoid recession, but then really grow only about 1.5% next year. And the reason why growth is still going to be sort of a little bit on the soft side is because of the delayed impact of the interest rate rises that we saw through the course of last year and through this year. So usually economists think that interest rate policy takes 12 to 18 months really to have its full impact on growth. So we're still living with the impact, and we're still going to be living with the impact at the end of the year of the interest rate rises that we saw in the second half of last year and the first half of this year. So that's going to dampen growth. And indeed, this year, corporate earnings aren't really expected to grow in most markets. Exception there is Japan. And next year, investment analysts are expecting reasonable growth, sort of single-digit growth, but still not spectacular profit growth. And so that's one reason why we're sort of on the cautious side of positive, maybe not to hedge our bets too much there. So we think that it's sort of a reasonable environment for stock markets looking ahead. But given the gains that we've seen so far, we'd certainly be a little bit cautious. And if there are any signs that growth was going to disappoint looking ahead over the next few months, that would be a reason to be a little bit more cautious still. But certainly when you think in terms of equity markets over the last year and a half really have gone nowhere, actually that's probably a good sort of starting point looking ahead to expect reasonable returns in the long run. But perhaps in the sort of near term, as we sort of end the year, perhaps investors shouldn't be expecting sort of more of the same that we've seen this year. I think there's a natural reason why equity markets might start to just perhaps stumble a little bit and stagger after such strong gains that we've had this year. It really would take a lot of more good news, a lot of more positive surprises, really, for equity markets to keep going as strongly as they have been. As far as bonds are concerned, central banks are close to calling it a day. The US Federal Reserve has pretty much admitted as much, and so has the European Central Bank. In the case of the US, the Federal Reserve has actually hinted that, or in its economic forecasts, that actually it thinks it could be cutting interest rates 4 times next year. So that is certainly a much more positive environment for bonds than was the case at the start of this year, with obviously the Federal Reserve continuing to raise interest rates. Bond markets generally do better when interest rates are falling, but they still do pretty well when interest rates are on hold. And so it looks as if we're getting close to the best time to be invested in bonds. And so that's one of the reasons why we've moved noticeably overweight bonds. Rather than government bonds, we favour credit, particularly investment grade. And that's because as long as the growth forecasts are met, whilst the growth forecasts aren't great, it certainly suggests that Europe, the UK, the US will avoid recession, that's actually a good environment for credit. It's only when the economies fall into recession that credit does really poorly. So you've got the advantage of the fact that interest rates ought to be peaking, a good environment for bonds in general, but then you can get the extra return, the extra spread from taking on the extra risk by investing in credit as opposed to government bonds. And so the second half of this year, we think is going to be a reasonable environment for bond investors. And as we start to get close to the point at which central banks start to cut interest rates, then that ought to be an even better environment for bond investors. So reasonable return expectations for equity markets, but we're not that excited. But certainly bonds, we think we're getting close to being perhaps one of the best times to start piling in.
Excellent. Thank you, Haydn, for such a detailed update. So thank you all for listening to our latest podcast. The views expressed in this podcast are the views and opinions of Santander Asset Management UK and do not constitute investment or financial advice. If you want to explore more of our views and insights, please visit our website at santanderassetmanagement.co.uk. If you require advice or guidance, we would recommend you contact your professional financial advisor. Thank you once again for listening to our podcast, and we look forward to speaking with you again soon.